Hey, what's up, everybody? Tim Albrecht here, and welcome to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist podcast, where we feature questions from you, the YFP community, to be answered by one of our very own fee-only certified financial planners. Please note this podcast is intended for educational purposes and should not be considered financial or investment advice, as we do not know all the variables to one's personal situation when answering a question. Before we jump into today's question, a shout out to our extraordinary YFP financial planning team that makes this segment possible. Your Financial Pharmacist offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. So whether you want to pay off your student loans, make the right investment decisions, or simply build a solid financial plan, we'll help get your income working for you rather than the other way around. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. Okay, this week's question comes from a community member in the YFP Facebook group. And the question is, my wife and I are both pharmacists, and last year on taxes, we were well above income limits to contribute to a Roth IRA. However, we were told about a backdoor approach. We both have traditional IRAs that were originally 401ks from previous employers, and our advisor said that we can shift traditional IRA funds into a Roth IRA regardless of income. So we could essentially convert the funds already there to Roth and then make future contributions to the traditional IRA after taxes and convert that to the Roth as a means to grow the Roth despite having too high of an income. Question here is, anyone else done this? Thoughts, experiences? Tim, this is something I know that has come up before, not only with clients, but also in the community, just trying to really understand for those that exceed the income limits, what is the option when it comes to a Roth IRA?
Yeah, so basically, just to back up, what everyone should know is that to put money into a traditional IRA, anyone with earning income can do that. Where it gets a little bit wonky is when you earn a certain amount of money, you don't necessarily get the deduction. So let's use an example. If I am married and we make $100,000 as a household, and we put $10,000 into our traditional IRA, we can deduct $10,000 from essentially our income, and it's to the IRS like we made $90,000. Now, once you get over an AGI for a married filing jointly couple, once you get over $125,000, then you can still put money in that account. You can still put the $10,000 in. You just don't get that deduction, so you can't, lower your income. What people do is they look at the Roth. So the Roth is interesting because once you make a certain amount of money, you can't put money directly into the Roth for 2021. So anybody can put money into a traditional. But once you make, as a married filing joint couple, it starts to phase out from $198,000 to $208,000. So once you make $208,001 as your adjusted gross income, then that Roth IRA door shuts completely. So what you have to do is essentially fund a non-deductible contribution into the traditional IRA, and then do what's called a backdoor conversion, observing two important rules that, again, I also often talk about, that I don't like talking about backdoor conversions because they can be more complicated than they appear. But if you have an advisor, he or she should be helping you with this, along with a tax person, to work through this. But the two rules are quickly the step transaction doctrine. So basically, if two steps of a conversion are completed within too short of a time frame, the IRS might determine that it's really one and the same transaction. So the idea is that if you put money into the deductible IRA, a non-deductible IRA contribution, there are rules of thumb that says you should wait 30 days and convert it. And there are rules of thumb that you should wait a year to convert it. And no one's going to say, from the IRS, is going to say, what is good or what is bad. So let's pretend you put money, Tim, into your IRA, a non-deductible contribution into your IRA, and then 48 hours you convert it. The IRS will say, sorry, bro, that's one transaction and you can't put money, you can't do it this way. So you can't convert and do it this way. So then we're going to disallow it, and you got to back that out. So the step transaction is one. Probably the more complicated rule is the aggregation rule. So this takes all of your pre-tax IRAs, your traditional, your rollover, your SEP, your simple assets, and it determines the conversion of associated tax. So if you have $0 in these type of funds, then it's typically not a problem. But if you say have $200,000 and you're trying to do a backdoor conversion, then if you were to put $6,000 into an IRA, $6,000, you're trying to convert $6,000. $6,000 out of a total balance of all those pre-tax IRAs is 206. That's 3%. So in reality, the conversion of that new IRA, which will be treated as only 3% of that is after tax, and the other essentially 97% are pre-tax fund that are taxable at conversion. So sometimes what people do is they roll the money from their pre-tax accounts into their IRAs. And if you're working with your advisor, they're probably going to tell you not to do that just because that's going to really make their fees go to zero. But people might do that where they might roll their money into the 401k, do the conversion, and then go from there. But again, I would be shocked if any advisor that is charging you based on AUM or commissions on that, they would advise you to do that. But that is one of the workarounds. So it's a viable option, but it definitely can be a little bit tricky as you navigate the investment and tax plans.
And we do, Tim, to your point about hesitancy and talking in detail about this, because we don't want folks to, think it's easier than it is to execute and find themselves making mistakes and then trying to unroll it, of which we certainly have seen. But we did an episode a while back, episode 96, talking about this in more detail. Certainly for folks that find themselves in this situation, talking with a YFP lead planner could certainly be of value as well. You can find out more at yfpplanning.com and book a discovery call. As again, this probably is one part of many that you may be thinking through with the financial plan. This question, as I mentioned, came from the YFP Facebook group. So if you're not yet a part of that community, this was one question that had good engagement from our community of folks chiming in, providing input. And that's something we see often, where folks are asking questions, getting those questions answered, sharing wins, being encouraged and challenged. And so if you're not yet a part of that community, please make sure to join us, and we'll link to that in the show notes. If you have a question that you would like to have featured on an upcoming episode, you can submit that question by going to yourfinancialpharmacist.com/ask YFP, or you can send us an email at info@yourfinancialpharmacist.com. Have a great rest of your week.